Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, copper, and Bitcoin. Today is going to be fantastic. I have got Michael Listman. He is well known on Twitter for being one of, if not the best UVXY traders out there. And we're going to talk about how Michael thinks that people can both lose and make money by trading UVXY. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading those CME Group event contracts. And that's what we're all using at Place Your Trades. So first, what I'm going to do is I'm just going to give you a quick overview of the market, and then I will bring Michael in. Okay, so let me see, get here to the right screen. Here we go. Okay, so this is what the app basically looks like when you load it onto your phone. Of course, this is just, what it looks like on my computer, but you can imagine here, you can see what in the world is going on with ES. Let's talk about that for a hot second. Okay, so I'm just going to go into my Tradeovate dashboard here. So basically what we saw into the close on Friday was, I mean, let's just call it what it was. It was a huge dump into the close. But if you follow me on Twitter, you saw that at the, when we got to the bottom of a channel that we've been in for the last, 7 or 8 weeks, I bought it, right? And people are like, you're knife catching. I'm like, no, I mean, maybe, but I'm just simply buying at support. There was support there at 4503. And so I bought it there. I thought it was a pretty good risk reward. I would do it again tomorrow. I would do it again the next day after that. I would always take that trade. I will always take a trade where, if we've been in a channel for a certain amount of time, if we're at the top, it's good to short it. If we're at the bottom, it's good to buy it. So what's happening now? Well, there wasn't much of a bounce from that level on Friday. Instead, it just kind of and then ended up just very, very slightly under that level. I closed it. I mean, I debated keeping it open because there was bullish divergence on the 4-hour, but I was like, you know what? I do not need that stress over my weekend. So I closed it. But today, that level is a little bit higher. This week, it's higher than it was last week. I am looking at 4526. If the hourly can close above 4526, then I think I'm telling you, there's a chance that this thing can potentially get a bit of a lift from that level. So 4526, in my opinion, is the most important level to watch. Now, as far as the statistics go, you can come on to Place Your Trades each morning, and you can check these daily gap stats. And they have them for metals, energy, indices. But this is particularly interesting today because for ES, we have a 59% chance and a 1.6 profit factor that it will open above, that will close above where it opened today. So those are pretty good odds, in my opinion, to buy the dip. We've got 58% in NQ with a 1.48. And then also the Russell. Now, speaking of the Russell, it's my favorite degenerate one. And if you go here, this is just sort of the Tradeovate dashboard here. You can see that I bought $50 worth this morning. I was like, oh, you're pooping, Russell? Let me just buy some of that. So I did. I bought it this morning. I bought the yeses. You can see I bought 17 of them. I bought them for $3. And I can't see from here exactly where they are right now, but I can see that for an investment of $50, I have a $63.75 profit. So I'm already doubled my money, more than doubled my money on that. So, I mean, it's $50, but yay. But anyway, that's how I trade them now. Everybody trades them a little bit differently. What I do is I wait till we get to sort of the real, what I would think would be, if it's going to reverse, it should do it here. And then I pick like a little bit of a degenerate thing. I do about, 2 strikes above that. And then I do the yes or the no, or, depending on which way I'm going. But that's what I did today. I bought the 1970 yeses for $3. So let's hope that they get to $20 today. That would be awesome. All right, that's it. Let's bring in Michael. Hi, Michael.
Hi, how's it going?
It's going okay. How are you?
I'm doing pretty good.
All right. So, for people out there that don't know, Michael and I, um, we've known each other a long time. And the first time I asked to interview Michael was the weekend before the COVID crash, right? And what had happened was, and I'm just going to full disclosure here, y'all need to know, I don't care. I had been trying to short the market and trying to buy UVXY and TVIX. Like I had been scaling in and scaling in and scaling in to all of those, like for about a month. It could be a little bit more, but no, it's definitely about a month before we really took a dive for COVID. Because just I'm not a macro person, but I just know when I see that they're like welding apartment buildings shut and stuff, that's probably a bad sign. So I had just been scaling into that, but it didn't matter because the market for a month kept going up by a percent. I felt like an idiot. Like I felt like I did not know what I was doing. And the entire interview with Michael, I'm like, so what will make UVXY go up? Like, I'm like, just again and again, I'm like, so would that happen? And would that happen? And it was just an incredible timing because then I got to find out from talking to him that day that when in fact UVXY does start to go up, Michael has some special statistics and odds that he can look at to tell me what the probability of the next level up is from there. So he helped me with my greatest swing trade of my career. It was not good for a month. Don't get it twisted, y'all. It was bad. But it was my greatest swing trade of my career. I rode UVXY all the way up. I rode TVIX all the way up to 1,000. I got out of my last right about there. It was incredible. But anyway, Michael, so glad to have you back on.
Great to be here.
Now, so your strategy that you employ in particular is one that a lot of VIX traders, they don't quite agree with your philosophies and methodologies, which maybe not a bad thing, right? Because everybody does the same, nobody makes money. But
Correct.
You're a person that in general your strategies revolve around nakedness, right? Can you just explain what your strategies are just in general?
Right. So my UVXY strategies have evolved over the years. I started with a covered call until that blew up on me. Then I moved to vertical spreads until that blew up on me. Every time I suffered a loss, I would look at, did I do something wrong? Is it just the market? What happened here? And what can I do the next time to avoid this particular trap? And I always knew out there that naked calls offered a way out of all of the problems I had with the other strategies, but it does carry that scary unlimited loss risk that everybody tells you, no, don't touch this, don't touch this, don't touch this. But what those naked calls give you is the ability to keep the trade going forever. You can keep rolling it, and you can use the inherent design of UVXY, which just keeps going down and down and down. You can use that as your backstop for this trade. But the whole challenge is when it does spike, how do you handle that? What do you do about that? And I've got ways that I do it. Other people have other methods that they choose to defend a position, a naked call position. But it really comes down to each individual trader handling their emotions, understanding their trade, understanding what's happening to them right now, so that they can survive a spike incident.
Okay, well, speaking of that, so before we get into the specifics with UVXY, can I just ask in general, when you look at the VIX, do you use seasonality at all?
So with the Brexit vote many years ago, that happened middle of June, and I actually not using seasonality at all. I played that one very well. I kind of had a feeling for what it was going to do.
You know,
But
I remember that. I was following you, and I remember you were like, you knew better than like the politicians and what was going on. Like, I remember that. You did a really good job there. Yeah.
well, a lot of the news events, news media tries to inflate it and get people excited. But if you think through things logically, you pretty much know what's going to happen. There are some variables out there, but if you try to filter out the noise, you can get to some kind of reasonable expectation. So, and I had that, and you know, before the vote, it was crashing hard. IV went through the roof. Um, I don't remember exactly my trade, but anyway, I came out way on top on that. The next June, I don't remember what happened, but there was the same kind of dip, and then I started to hear about the June swoon, uh, and how this is kind of predictable for one reason or another that it's going to happen. Uh, so this year, I'm all ready for it. I'm ready for that June swoon. Even in January, I'm like, well, you know, I might not be doing great at this moment, but I've got the June swoon coming up because it happens every year. And there's a website called I believe it's equityclock.com that will give
Yeah.
you the seasonality on anything you want.
But so you put stuff, I mean, I really believe that you are so good at this, but you put stock into that though. You really do believe in the cycles.
Well, yes and no. So everything for me comes down to probabilities. It's all quantitative. You know, what's my probability here? You know, there are times when that's not going to help you, but so I'm waiting for this June swoon to come. Uh, I'm loaded up for it. I'm not outright long volatility, but I'm long bias.
Okay.
And kind of playing both sides, but I'm heavy long bias, and I'm waiting for this June swoon this year. Doesn't show up. Okay, second week, third week. Where is it? And you know, I'm listening to everybody else out there saying, you know, this is the month we're going to get our big sell off, and June comes and goes, and I think we barely had a red day for the entire month of June. So that was trying to time the market using seasonality is trying to time the market. And I was like, you know, I thought I had this one a lock. I was trying to time the market, trying to be a little smarter, and it just wasn't there. Now next year it'll probably be there in spades, and I'll be how I'll use the seasonality and those types of indicators is just another little thing in the back of my mind that, hey, this is out there.
Right.
Don't get too far over your skis if this is going to come to pass.
Well, I mean, I guess there's two options here, right? I mean, everybody knows, I think, even bulls and bears. I don't know one person, not even a single person, that if you said, hey, is August going to be bullish? They would say, oh yeah, man. Oh yeah. Like I don't know, but I knew a lot of people that felt that way in July. I knew a lot of people that were like, July is the most bullish month, you know, but everybody seems to be in agreement, bulls and bears, that August is going to see a pullback. I mean, it seems like it to me. I mean, so far so good, right? For that strategy.
Right.
But yeah. But the question really is, you know, how, if volatility will act the same, what if there's a correction, but it's more like stair step as opposed to like a credit event, or like, you know, whatever, another problem.
Right. Well, volatility is all about velocity, the velocity of the move. So when we had the COVID spike, that was a drawdown of SPX of 30% in 30 days. And that's so why that's why UVXY went 10x over the course of that month. But you take last year, the SPX was down, I think, 27, 28% from its high to its low. And volatility never did anything. I think there was 100% spike in there, didn't do anything because there was no velocity. So if it's going to just stair step down, people can digest that. They've got time to manage their positions. They don't need to take out heavy hedges.
Yeah.
There's no panic. So you're not going to have this increase in volatility. People
Well, I
ask
think
me a lot, what should I use to, I think a crash is coming. What should I use? Should I use a triple levered like S triple Q or something like that to take advantage of this? Or should I use UVIX or UVXY? What should I use? And I can only tell them it really depends on what you are expecting. Are you expecting a big crash all of a sudden? Or are you expecting, just generally to drop down? Because that's going to matter on which vehicle you choose to take advantage of that.
I remember that we actually met because you were trolling me because I was posting that I bought UVXY right before COVID. Don't get it wrong.
Right,
but
right.
You were trolling me a little bit because that's, I say troll. You were teasing me because I was tweeting out loud that I was buying this thing, and it was, and actually even before that, but you know what, like, so I guess I haven't traded it really since that swing trade. It's almost like I wanted to say goodbye to it. Like, I haven't felt the need to do it because I don't feel I'll ever, I don't think I'll ever be able to do it again.
Yeah,
like,
that was well, so a 30% pullback in SPX is a once in a decade event on average. So that in itself makes it rare. To compress that into a month is going to be even more uncommon. So to repeat a 10x, while it's not impossible, the odds are stacked against that.
The odds are pretty low, right? Yeah. So that's why you haven't seen me tweet about it. I just can't, I'm just waiting for Michael to come after me if I ever buy it now. Like, but you know what, guys? I did actually text him the other day, and I was like, "Is it time?" Because there is a certain threshold that if UVXY spikes, and I know that, Michael, you look at the very low of where it's been so far, right? And then you say if it spikes X% above that, then it has Y and Z odds of going higher. So what is that? What is that you look for? How much percent from the lows do you start thinking, oh, maybe it's going to go a lot higher?
Right. So this is only a generality, a framework. I use the all-time low, and UVXY, the way it's designed, it just keeps crushing lower and lower. So it makes these all-time lows rather frequent. I just tweeted the other day or yesterday, I think, that on average it does it every other week. You're going to get a new all-time low every other week. They can cluster, and there can be deserts where there are no all-time lows, like for a year or so, and then you have one where it's every day for 2 weeks.
Yeah. I remember it was close to that at COVID. Like, what in the world?
So what I did, and try to quantify the risks to me from any particular all-time low. What is the chances that it spikes 10%, 25%, 50%? And I didn't start out with those numbers, but the data kind of led me to those levels, and I tried to make it as simple and easy to remember as possible: 10, 25, 50, and 100. And I came up with the frequencies that these occur throughout a year or over any span of time. So like a 10% spike will happen once a month. A 25% spike will happen once every 2 months. A 50% spike will happen every 6 months. And a 100% spike will happen every year and a half. And then from there, you can just easily say, okay, well, if we hit a 10% spike, what are the chances we go to a 25% spike? And that would be, well, it happens half as often. So if we get there, it's a 50% chance that it keeps going. The 50% spike happens, almost half of that again. So there's a 50% chance if we get there, and then there's like a 33% chance to get to 100 once we've gotten to 50.
I love that. So,
but it's still a sloppy trade.
It was
those
bad.
Those ranges are wide. So I'll count a 24% spike still just counts as a 10% spike in as far as my analysis is concerned. You've got to draw the line somewhere. But
well, that's, I feel like I'll start interacting with you more on Twitter if we get to what, you know what I mean? Because like, it just, to me, I don't know if there's going to be I don't know what's going to happen. We all kind of think there's going to be a correction. The question is how, and I just haven't messed with UVXY yet, but I'm thinking about it. That's why I texted you the other day. I was like, should I be looking at this?
It's been a year and a half since the last 100% spike. So technically we're due.
We're due.
And I think I put the longest span in between those was 26 months. So it could go on. It might not be till next spring. So
it's not worth buying. Y'all don't buy UVXY and hold it thinking. I mean, that's what I was doing before COVID. But anyway, don't do that now. Well, I don't know, right? I don't know.
There's a horrible cost to get in too early, even if you're in a week or two too early. It goes down. Yes,
I know.
You need to make that much more of a spike just to get even.
I was down about 35% before it started going up. Full disclosure, y'all, and I was all in. Like I was convinced. But I was down about 35%. It was bad. Just being honest. Okay, but it ended well.
Yes.
Anyway, so Michael, let me just see. Hold on a minute here. All right. Before I go to these other questions, I just want to make sure. Okay, let's talk about zero DTEs and the effect on the VIX, because the people who think they're smart, a lot of people who think they're smart, have talked about zero DTEs are the death of the VIX. The VIX no longer matters. Nobody's looking at the VIX. The VIX is dead. What is your opinion on zero DTEs and the effect on the VIX, and how do you use that at all in your work, or do you just kind of, what do you think?
So I've been having this debate on Twitter for quite some time now, probably almost a year since they went to the full 5 days of zero DTE. And I remember seeing, I believe it was in last December, SIBO put out a chart with the volumes. They were highlighting the volumes of zero DTE and how they've exploded, but they also showed the constituent options in the 30-day VIX, which are out 27 to 34 days, and that those volumes had not changed at all. So it's not like hedgers and traders are taking their 30-day VIX and moving them to 0-day VIX. They're still buying and selling 30-day VIX just as much as they ever were. I have not seen that updated. I actually called or emailed SIBO to see if they could reproduce that chart, and they claimed that they didn't even do it. So maybe I saw it somewhere else. But if the volumes of the 27 to 34 day VIX or SPX options has not changed, then how can you argue that VIX is destroyed? Because the same level of activity, the same institutional activity is still there. Now, you might be able to offload some of your hedging opportunities on zero DTE, but that is a very inefficient way to do it. Costs are higher because you're at the fattest portion of that theta decay. So if you're buying VIX calls on a zero DTE basis, that's going to be way more expensive than buying out 30 days. A lot of the volume of zero DTE is simply speculative. It's not necessarily hedging. You've got lots of traders. It's easy. It's a day trade, almost like the event contracts. It's over at the end of the day, and you can be done. So, the final pushback that I have against that is you can chart the realized volatility against the implied volatility, and you can look at how they relate historically. The only time they'll diverge is on a big spike when realized hasn't been there, and suddenly implied goes up. But they always come back. They always stay within a tight range, and that has not changed in the last year since zero TDE volumes have exploded. So to say
So
that
no,
VIX
so
is,
no.
yeah,
So
I say no,
you're
it
like,
hasn't.
you're like, keep
Nope.
talking while I'm making money over here. Like, keep talking about it, right? Like, who
Well,
cares? Okay.
so even if that's your position that VIX is no longer valid, what does that do for your trading?
That's what I'm saying. Like, they're just talking and you're trading.
Right. I mean, do you say, okay, well, since VIX is broken and all these ETPs are based on futures, which are based on the VIX, if all that's broken, then why would you even trade it anymore? Because your narrative is that these don't work, it's manipulated, so move on, trade something
Well,
else.
well, speaking of manipulation, there is sort of a crush the VIX Friday thing that people like to talk about. And I guess somebody asked me to ask you what the Monday effect of the VIX is from the Friday crushes. Do you wait until you might close out for the week on a Friday? What do you look at Monday effects on the VIX?
So no, I do not, because nobody does. It's there. It's undeniable. The VIX pops. Relative to market
Right.
action, the VIX is higher. But if you look at the VIX futures, they're like, yeah, no, we're not interested in that. They ignore it. So
You
none of
know,
the EEs follow along. It's simply the VIX. Everybody knows this. Everybody knows what's going on. So it's not tradable. There's nothing you can do with it. Friday is a different story, but Monday is not tradable.
have you traded those micro VIX contracts?
Um, I believe I did quite some time ago. Uh,
I
I
tried
haven't
it.
I haven't recently.
I tried it recently and it was boring. It was like I couldn't even. I was like, oh no, like I can't even. I gotta go back to my beloved indices because like it was like I was just sitting there. It was.
Well,
Well, I mean, I guess
if
that
it's
makes
not
sense,
moving, then yeah, yeah.
right? I guess it makes sense. Like it, but I don't know. I don't even know what I was. I honestly just wanted to trade them because sometimes I can tell when there's something that's gonna. Sometimes I'm like, I don't know what the indices are gonna do, but they're gonna go either up a lot or down a lot, and either way, I think it'll send the VIX up. So then that's when I did it. But I was just like, for the
Right.
money and everything, I was just like, this is boring. Anyway, okay. Now let's talk about the questions that people wanted to ask from Twitter. So the most, I think it was asked a few times. Michael, you sell naked calls.
I do.
What is your strategy for when do you start to get worried? Number one, and number two, what is your strategy for dealing with that inside of market hours and outside of market hours?
Okay. So my approach is one that almost everybody warns you not to take, and that is setting profit goals or targets. Uh, and I understand the warning because that can set you up for angry trading or YOLOing uh, to hit your target. But for me, what this does is informs my allocations. So I'm looking at I have a profit target for the end of the year, which everybody should know by now is 100% per year, which is 1.345% per week compounded. So if you do 1.345% every week, by the end of the year, you'll double your money. Now, of course, nobody can do that. The market's not a machine, it's not an ATM. So every week I'm trying to be loaded up with a little bit fatter than that to account for movement and maybe having to get out of a trade, give back 5 cents to the market maker to get out. I might load up to 1.5%. Just in general, if the market's giving me a fat pitch, I might go up much higher than that. But um, my core trade is to sell naked calls and to collect premium, and depending on the market, if it's just trending down, IV's low, then I'm looking to collect some alpha for that. So I would sell some in the money calls against that to collect as the price drops. I'll use all different kinds of spreads. I'll use verticals in IRA accounts that I manage. Obviously they have to be risk defined, so there are verticals there. I've used all kinds of butterflies, ratios. I don't have a case for each one. Like, I'm only going to open up ratios this week, or I'm only going to open up naked calls this week. It's really market dictated, and also based on what I currently have in my book, because oftentimes I'll trade off of the positions that I already have in my book.
I see.
So once I have a profit target, I've loaded up. My next most important thing is, what do I do when this blows up on me?
Right. Well, yeah. And I mean, what do? Do you have like an alert saying, the market is down X%? Like,
well, it's
screen.
So since everything is based on targets for me, this is also based on a target loss. So my target loss is down 20%. So I found that a drawdown larger than that becomes much harder to recover from, whereas a 20% drawdown in a spike condition can be relatively easy to recover from. So that's kind of my line in the sand. So that may or not be a larger than 20% spike in UVXY, depending on how much I'm loaded. But at that point, I'm looking to defend. I can't bleed anymore on this. So I might buy shares. This is what I did with the COVID spike. I just bought shares, became delta neutral. It just became a covered call. I just kept rolling the call underneath and collected a little bit more premium each time. And I only needed a dollar or so to get even. And in a month and a half, I was out with a tiny little profit in the face of 10. So
I tried to convince you to come along with me, and you were not having it.
Well, full disclosure, during that time, I would scalp. There'd be some days.
Yeah, I remember scalping. Yes, I remember.
Yeah, I was sharing trades with other.
You're really good at it too. Like, because I would just hold it longer than you. I would read.
In the wash, it was 50-50. I'd be scared out. Maybe this is the crush. I don't want to be holding this if we're going to crush. Maybe it's not going to pop. So I would do some overnight holds. I would just do some day holds, and some were big wins and some were big losers. And at the end of that exercise, it just convinced me even more that I'm not a day trader. I'm not going to follow some little trend. My edge is collecting premium and putting on a position that I can defend and eliminate losses, or do minimize them at least.
But how perfect was that TVIX 1000? That was 1000 and down.
Yep. Well, and UVXY hit 135.
Yeah, I remember. I mean, we were like, yeah.
And I remember that last spike, because you would always be like, well, what are we doing here? What are we doing here?
I know, I was.
And at that point, based on my previous studies of spike life cycles, there had to be a flush out spike, and I had not seen that with each ramp. I was like, we haven't. They haven't said, okay, it's over, Uncle, we're done. And if that's the case, then there's probably still more juice to go higher. So that's what I kept seeing and kept sharing with you.
Yeah, that was awesome.
And I remember the last day, I was like, I don't see it going farther than this. And lo and behold, it spiked up that last day, and then that was it.
March 23rd was the bottom. I remember that specifically because I had already gotten rid of my volatility stuff, and I took my account and I went long. Did I hold it the whole time? No. No, I did not hold my long as efficiently as I held that short. Boy, I held that short. I mean, well, you know, the UVXY, I held that. I was like, but I did not hold on to my long as with so much conviction, because I didn't know. Like I knew that we were close to a bottom, but I didn't know it was a bottom. You know what I mean? Like I thought we might go 32, 34, 33, you know, and then I didn't know. I wish I'd held on to that. Would have been something to talk about, but it would have taken longer. So
right. Well, and when it turned, there wasn't like a news event. There was nothing that made sense to make it turn. The narrative didn't change. COVID didn't go away. Everything didn't just open up. There was none of that there. So if you were trading all this based on a narrative, you had nothing when it turned around. And you know, everybody was like, you know, why is it rallying? Because it just went straight up after that. And it was just the market had collectively decided that, you know, yeah, this is bad. And we're either going into the abyss and everything gets destroyed, or it's going to come roaring back. And so they just decided, hey, we're just going to hold our nose through this. And in 6 months, it'll probably be better.
yeah.
And, you know, right or wrong, where people put their dollars is where the market goes. So
help me out with some of these questions. I know, you know, when I had asked for people to post the questions, I just want to make sure that I'm covering all the questions. So one of the questions is, do you buy leap put long dated on UVXY when it spikes? The answer is no. You just sell.
I do not.
Right. You just sell.
Because yes, it's a risk-defined trade and it helps you sleep at night. But if you look at how much premium is in that put relative to where, if you apply a decay rate to UVXY to where you think it'll be in a year or 2 years, and you look at how much premium is already loaded in that put, the market's already taking half of that profit away from you. And if it doesn't go, if it only goes halfway, then you've tied your money up for a year or more with a scratch. So yes, they're risk defined, but the profit potential is just very limited. And it fits in with risk equals reward. There's no escaping that equation. You can't cheat that system.
Okay, and then we have another question. When selling the call spreads during the spikes, you assume the short legs is at the money. How do you choose the width of the spread, the duration of the spread? Did you open spread 2 months out last week? What is your plan if 25 spike continues, turns into 50% spike?
Okay, there's a lot of questions right there.
I know. The first one is really important though, right? How do you choose the width of the spread and the duration of the spread?
Right. So the width, the wider you go, the lower your capital efficiency. This is still risk equals reward. So if you do a $1 wide, you're going to get the highest bang for the buck. You are also sacrificing safety, because if it blows through there, it doesn't take much to blow through a $1 wide strike as it does to go through a $10 wide spread. Mm-hmm. But your ROI on a $10 wide spread is going to be much, much lower than a $1 wide. So I'll lean into my probabilities of it going back down or this spike continuing, and I'll use that to kind of inform what I want to do. You know, do I want to go for it? I'm only going to do $1 wide out 2 months or 3 months or 6 months. It's all based on the current market conditions and what I'm thinking going forward. How long is this going to last? Is this a 25% spike leading into a 1,000% spike? In which case that would be wiped out. Or it could still go to 50% in the next week, next couple of days. But by the time this comes to expiration, you know, it's well out of the money, and it's max profit Friday for me.
No, I know you're a statistics dude, but did you just really say that you used art? to define the spread? Like, is there a quantitative way to define?
There would be, but like I said, this is a messy trade, and
Yeah.
I think you're going to get diminishing returns by trying to get too cute with it. It, like I say, it's a messy trade, and it's only through years and years of screen time that I've developed this kind of kinetic feel for how volatility is acting on any particular day, and then how I think it's going to play out in whatever future I'm trading through.
Now, somebody says, how do you know when to put on the next trade? I mean, because you don't necessarily wait for spikes all the time, do you?
No. So as an actuary, as a seller of premium and time, if I'm not selling time, then I'm not working. So if it's not an optimal time to sell, I might go lighter, but I'm still going to have something on. Otherwise, I'll have FOMO as it keeps crushing down. That can be very frustrating. You're very lightly loaded, and UVXY drops 10% on you, and you eat almost nothing off of that plate. But that's part of the trade. You can't win every single one.
Michael, I gotta ask, because I'm a degenerate, right? Just by my I'm a degenerate. I am. I am. That's how you met me. I was long UVXY.
Yep.
But like, what if something bad happens? Like, what if China invades Taiwan on a Saturday? What do you do? Are you changing your law? Like, what? I mean, do you risk that? Do you often sell? Like, do you often have positions over the weekend?
Always.
That would freak me out.
Always. I mean, if you put on a spread for 2 months out, you've got positions on over the weekend or overnight. I mean, there's nothing special about a weekend as opposed to overnight.
Is there a way to hedge during the week? I know, but no, there is actually, because if it's overnight, I remember you did this once when you were actually hedged, but I think it was during COVID. It was during COVID. You actually traded futures during the middle of the night, because we were the best friends we've ever been during COVID, because like I was like relying on you pretty heavily, and I don't know that you use my charts at all. I don't care. But anyway, I benefited from it. I don't care.
Right.
But I remember I think you went long or short futures overnight. I don't remember.
I would have gone long. If I was hedging naked calls, I would have gone long the futures.
I think you did. I remember you doing that. But so there is a big difference, because overnight you've only got 1 hour each day where you can't protect from Monday through Friday. You've got the 1 hour break from 5.
Well, even then, during that 1 hour when you can't trade the futures, you can still trade the shares. So there's an 8 hour overnight where you can't trade the shares.
Right. Right. You can. Right. You can. And I think there are some brokers that now allow 24-hour trading, but probably not on this UVXY stuff, right?
Yeah, none of these tickers.
No. Okay. All right. So there is a big difference. There's a huge difference, in my opinion, between the weekend and the overnight because of that. So what do you do? You hear that, let's say this weekend that China invades Taiwan. I don't know. I'm making that up.
Right.
But what do you do?
Well, I mean, there's nothing that you can do as that happens. The only thing you can do is trade once the market opens.
Okay.
Everybody else is in that same boat. So, you want to try to keep a cooler head. Don't panic like everybody else. Sell.
Right.
But I lean to my research, and what is the maximum over weekend drawdown we've experienced? What is the average?
Okay.
Does that get faded when that type of move happens? So all of that is used to at least keep me off of the edge of the cliff there.
Yeah.
I might not be trading, but it gives me some confidence that, hey, this probably isn't going to be the end of everything. But you never know. It could be.
Okay. So, all right, let me just find another here. I guess, George is asking, in what situations do you do the butterflies, the ratios, the calendars, the diagonals? Like, do you have, because I think you've used zebras. You've used, like, I don't know what you were using. It's something like irradiated swans. I have no idea. You have the weirdest terminology for what you do. But
well, a zebra's a real, somebody else made that up.
I know. I was making that up, but it sounded like you were making it up at the time.
Well, I added a third leg to it, so I called it a three-legged zebra, because with a zebra, you've got an extra long call or a long put that's not doing anything for you. You're just hoping that it increases in value. So I'm like, well, crap, I've got a long position. I want to trade against that. I want to monetize that. So I'm adding this third, selling weekly out of the money against it, to try to just collect even more premium off of it. But
so tell me explain to me, not like I'm 5, because I think you'd have to be at least 10 to understand this, but like, tell me how you choose what strategy, if there is a particular methodology.
It's going to be very personal, because there's so many different ways to trade it, even with an individual strategy. So, like a ratio, I've been doing these out of the money ratios on natural gas, because natural gas is just this horrible, freaky thing that moves, and nobody understands why. They try to understand at the end of the day, but they're still pulling at straws. So
I used my lizard indicator for natural gas, and I think it's probably as effective as the most effective hedge fund.
Could be. So I'd buy one lot way out of the money, and I'd sell a 2 lot even further out of the money. So I'm making money if it never gets there, but if it gets there, breaches my long strike, I've got this little space where I can really make a killing. But then once it gets to my short strike, then I've got to do something. There are multiple ways to defend that if it does get there. And there's this, small profit if it's below, which is what I've been happy with, just eating that on both sides. But there are multiple ways to defend that. So I would put something like that on if I thought something had a wide range. It was being extra volatile. I still wanted to play it. I wanted to be in the game, but I didn't want to take, like a hard 50 delta risk or a delta 1 risk on a position. Butterflies, ironflies, all those, you have to look at the profit and loss curve and see where that leaves you based on wherever spot finishes anytime during that trade. And you need to decide why you did that and how you're going to manage that. For me, a butterfly I'll put on as kind of my low risk chance at a home run trade. If I can pin that short strike, I've made like 2-3x on that money for that week. It's rare that it's going to hit, but I'll throw some of those on just in case, just for a play, just maybe.
Okay. Any other wisdom you can give us about how to choose?
I can go on all day long about why I did this here and did that there, but
I don't want any of that. I want future. I want like
right. And then but the most important thing, if you hear nothing else, it's that it's you and the keyboard. It's not somebody else. It's not following somebody else and what they did or what they do, because while you can follow them, when it starts to get hot for them, they're going to react earlier. They're going to react differently than you're going to react.
Yeah.
So whatever trade you use has to be yours. You have to own it 100%. You can take somebody else's, you can learn that, you're going to modify it a little bit, but it has to be yours 100%. Otherwise, you're playing with fire.
I agree with that 1000% for any kind of trading. I
Any,
always I
any.
get more stressed out about other people following my trades than I do about my own money in my trades, because like I know what my risk tolerance is. I know what I'm going to do, but they don't know what they're going to do. And
Exactly.
yeah, and so okay, so marble volleyball, which is a weird name, but I'm kind of into it.
Okay.
Because once you're in moderate defense mode, they're not to the point of protecting with long shares and not expecting imminent vol crush. Do you ever roll to higher calls in an attempt to collect more premium? You do, right? I've seen
Roll
you
to
do that
higher calls. Well, I roll my tested calls all the time.
all the time.
Yes. I mean,
But
like
if you're in moderate defense mode, is that one of your strategies that you roll it out?
no, usually, and this is a tasty trade recommendation, that you don't touch your tested strike. And many times I would try to manage it, think, there's 15 extra cents of premium here if I roll it here. But I've never had good success monkeying with my tested strike. Um, I will manage it by adding something else to it, trading around it. I'll sell some at the money puts or out of the money puts or in the money puts against it. Uh, if I was light in my book, I'll use that opportunity to maybe load up a little bit more. And at that point, I might sell something out of the money against it, just to make it a higher probability, short duration, uh, just to try to milk it a little bit.
Okay. And okay, and I just want to, did you look through all these questions yourself? Do you see any that I didn't? Because Plain and Simple had a like Michael, they were doing professional interviewing type things. I felt terrible because you know what I have? I have like little like notes here that are just ask him this. But this guy wrote out, or this woman, whoever, wrote out, when UVXY spikes 25% or more, you'd sell call spreads in the IRA, but you add short call/call spread in your regular trading account, question mark. You mentioned in your latest interview that you deploy roughly 1/3 of net liquidity as initial margin to short weekly call each Friday to achieve 1.3 weekly return, which would compound to 100% return over a year, which is your investment objective.
They were paying attention.
This person is like, I want this person to take notes in meetings with me, because sometimes I write down what I say and not what the other person says. Like, what am I doing? Anyway, okay. So, I believe there's another reason to leave 2/3 net liquidity on hold, which is to give enough and safe buffer for the changing margin requirement when UVXY spikes. If you continue to short UVXY call with your regular trading account after UVXY spikes, is it too dangerous as the margin requirement will spike much more? I hate when they do that. Those jerks.
Well, yeah, and Interactive Brokers is in that state right now where they're wanting anywhere from 200. I think one time I computed it was 275%, but I think right now they want 200% of notional. So if we're at $19 now, they want 3,800 per contract to short that, whereas normally, and all the other brokers, TD, Tastyworks, they still only want the $1,900 to short a single contract. If you're doing that in a Reg T margin account, then yes, you really need to pay attention to that, because there's nothing that you can do about it. But in a portfolio margin account, you can offset it with a throwaway position. So that $38 of margin is like tripling the price. So you just need to buy a call, something less than that, and that will reduce your margin requirements down to whatever call that you've purchased. And I just call them throwaway calls because I know I'm burning money, but I'm just doing this to reduce my margin requirements so that I can still trade. Because the worst thing that can happen to you is to get margin called and you have to start closing stuff that you don't want to. They might be winning positions. You're like, crap, I got to lighten up somewhere. I got to find some margin somewhere. And in a Reg T account, you're kind of locked into that if you haven't left yourself that room from the outset.
Yeah. So, Michael, for somebody, okay, I guess there's different levels of traders, right? There's people like there's retail traders, right? And I don't trade. Like I said, I haven't touched UVXY
Right.
really since COVID. I haven't. Maybe I don't remember. If I did, it was like I wasn't like I wasn't buying degenerately like I was then.
Right.
But like, I guess the question is for people in general, would you ever recommend that they touch? I would say no. I would say people in general shouldn't mess around with the VIX, because I know people. What was the ETF that went? It was short the VIX in perpetuity, and then it went to like zero overnight.
XIV or
XIV. I know
XIZ. One of those.
XIV. I know people who had literally they had 10% of their 401k in there because it was just. I mean, like, I don't blame them, but like
right.
it turned to zero overnight, guys. Like literally, with overnight, people lost 10% of their entire portfolio or more, because there are people that were more degenerate, because XIV
right.
wasn't even really highly leveraged. So would you say that would you recommend volatility as a trade to most traders, or do you think there's other things out there that are possibly easier?
It goes back to the risk reward equation.
Okay.
Whatever you're comfortable with taking, I will never tell anybody that you should not do this.
Right.
There are people who go long UVXY, despite all of my advice to the contrary, and make money. There are many more that don't make money, but whether or not you're long or short, it all comes down to you and the keyboard and how you interface with the markets. When you decide to pull the trigger, when you decide to get out, that's on you. It's not on the symbol. It's not really on the market, because everybody else is trading the exact same market. Some people profit, some people lose. You're the variable. So anything somebody wants to do, I always recommend, if even selling naked calls, just trade it as a one lot for a year, so that you can see everything that it throws at you.
Okay.
And fight it. Well, fight it like you've got 100 lot on or 1,000 lot on. Trade it for real. But that's the only way that you can learn it. Get that screen time in. Go through all the emotions of what it does to you over the course of a year, and at the end of that time, you would probably have a good feeling of whether or not you should be doing this or not.
Yeah. Okay. Yeah. So, and then I think that's a good note to end on, actually. I think that's fantastic. So, Michael, I hope we get to interact on Twitter more. In other words, like, that would be like, if we spike more, or if I think that we might, I don't think we're ever going to get like a whole month-long period again where it's like flashing lights to me that I should buy this thing, even if I was wrong and early. Like, I feel like we're never going to get that again. Am I wrong?
Something could happen. I mean, the first spike that I really studied was July and August 2015, and that was the basis of my strategy formation at the point. And so there was a spike in July. People thought, oh, this is bad, went away. But then August came around again, and bang, it was a 3.5x spike in a couple days. So that's always out there. Always.
It's always out there. All right. Well, I hope that I see an opportunity to interact with you more on Twitter. Okay. Or actually, I don't know. I just hope I make money either way. So
that's why we're here.
Yeah. All right. Well, thank you so much, Mike. I appreciate you. And I really enjoy following you. I think you're fun, and I think you're really useful to people. And you're nice about answering questions too. I have seen you exercise amazing patience, and I appreciate it.
Yeah, there's a never-ending procession of people new to this area and this trade, and they all have the same questions, and they all need to be answered. And as a give back, I'm here answering the same question over and over and over again, and that's fine. That's fine.
Yeah. And I mean, and you're and you're actually somebody who I can understand. Some of the volatility traders I follow, I know they're amazing. I know they've got, amazing strategies, but I don't understand them. And I don't want to even understand them. I want to go, Michael, what are the odds of it going higher or lower? Just tell me. All right. Anyway.
Many of them have different audiences. They're going for,
I know
firms
they're
and
professional. They're
institutions.
professional volatility traders.
Right,
I'm just a
retailer.
yeah, I'm just a retail schmoo.
Yeah.
Anyway, everybody, thank you so much for joining me today. I'm Cordova Trades on Twitter. This is at Michael Listman on Twitter. He's the UVXY source for information. And also please follow at Place Your Trades. And Michael, I wanted to congratulate you on your success. I know you've ventured out on your own and you've been doing really well. And I wish all of the best for you in the future. You deserve it. All right, everybody, take care. See you on Interwebs. Okay, bye.